Hello, this is Randy Alsman from Donaldson Capital Management. I'm a senior portfolio manager, and today I wanted to follow up on a blog I did back on September 2nd. Back then I was answering a question from one of our readers that wanted to know how there could be such varying financial forecasts, economic forecasts from the same sets of data. And there was also, in my mind, an implied question there, which is less about the economic outlook and more about how do you guys think about what the stock market might do over the next several weeks or months? And what I wanted to do today was to talk a little bit about what we call our Barnyard forecast. We've been doing this Barnyard forecast for years, and we call it Barnyard because it's the equation of E plus I plus E plus I equals O. Corny, I admit, but nonetheless it makes it easy to remember, E-I-E-I-O. And those letters stand for earnings plus inflation plus economy plus interest rates equals outlook. And in fact, what it is a little bit of a modification of what some people have called the Fed model. We use this equation, this Barnyard forecast, as much as anything else to try to anticipate what we think the Federal Reserve Bank might do in order to stimulate or to restrain the economy. The Federal Reserve will claim they have lots of tools to manage the economy, but in essence they really just do one major thing, and that is to expand or contract the money supply, mostly through interest rates, although they have become very creative of late and have found other tools to use as well, but primarily interest rates. The higher the interest rates, the tighter it is for businesses to borrow money, the harder it is for them to grow. The lower the interest rates, the more expansive the economy can be, the easier it is to borrow money and to invest aggressively and to grow. So what we do with our Barnyard forecast is try to guess as best we can what the Federal Reserve's approach to the money supply, to interest rates, will be in the following year or two. And we look at the last 90 quarters of time that we have applied this Barnyard forecast. We find that it has been accurate about 60 of the 90 quarters, about 2/3 of the time, and it's missed 1/3. So it's not a precise tool, but it's worked out fairly well as a general directional tool, and that's how we use it. It doesn't predict level or quantity, it predicts direction as much as anything else. How do we define accuracy? If the tool predicts that the market will expand or grow over the next 12 to 18 months, then we look at it beginning 6 months after the forecast. So we start on month 7 and we measure the stock market for the 12 months following that, months 7 through 18. If the stock market does indeed average higher over that 12-month period, the forecast was correct. It was accurate. If we predicted, or the Barnyard forecast predicted, the market would contract and the market is indeed lower for months 7 through 18, we consider that that is correct. So let's move on to what we're looking at right now. What does the model tell us about the next 7 to 18 months of the stock market? Well, let's start with the first E, the economy. Normally 3% global domestic product, gross domestic product growth is considered optimal non-inflationary growth. Therefore, if there is a reading below that, then the Federal Reserve theoretically would be interested in encouraging it to grow a little bit faster. If the GDP growth rate is above 3%, then generally the Federal Reserve would want to restrain growth a little bit to avoid the economy becoming overheated. And we look at the rolling 12-month period prior to us doing the forecast. It's not just the last quarter, it's the last 4 quarters. As you all know, we've come out of a pretty deep recession, and the last several readings of economic growth, with the exception of the first quarter of 2010, have been well below 3%. Therefore, the score for this particular measure, the economy, is one of encouraging growth. So this is a positive for stocks kind of measure right now. Low GDP, therefore we expect the Fed to want to encourage growth if this were the only measure they were looking at. The next letter in the EIEIO is I, and it stands for inflation in this case. And as you know, the Fed has not expressed a specific target for inflation, but they've said that they've been comfortable with about a 2% inflation rate, 2 to 2.5% inflation rate. That would make them feel like the price expansion is about right to encourage growth, but not so high as to discourage it. And as you know, we have been in a period of time where some people are worried about deflation more than they're worried about inflation. Certainly with the most recent core CPI number being 0 for the latest month, that's indicative of the last year or so. We have less than 1% core consumer product inflation growth rates over the last 12 months. Therefore, it's below the optimal level. It's not at a level that would cause the Federal Reserve to want to restrict growth at all. In fact, it's at a level where they may want to try to provide even more stimulus to the growth. Therefore, this is also positive for stocks in this model. The next letter in the equation is E for earnings. The historical average corporate earnings growth rate, earnings per share growth rate, has been about 7% over the long term. This is one number that is somewhat independent of the Fed. I'm sure they look at corporate earnings growth rates, but it's not formally a part of their model. If you look at corporate earnings normal growth being about 7% over the long term, and this is the prior 12 months, anything above that would mean that the corporations are growing very well, and the Federal Reserve would be happy with that as long as the economy and interest rates and inflation are under control. So they're happy with good corporate earnings growth, given those other things being at normal levels. And right now we're seeing exceptionally high corporate growth rates. It could be up as much as 46% for fiscal or for calendar 2010. And again, in calendar 2011, the outlook is for it to be in the neighborhood of another 15 to 17%, at least as current estimates. Therefore, the fine rate of growth that we're seeing from our corporations out there is very positive for stock market growth over the next 12 to 18 months. The last letter in the EIEIO model is interest rates. There we take a look at a relative measure. It's not an absolute measure. So we're not looking at a specific number. We're looking at how interest rates compare right now to where they were a year ago. If interest rates are higher now than they were a year ago, that's an indication that the Federal Reserve is tightening the money supply or tightening control over it. If interest rates this year are lower than they were a year ago, it's generally indicative of a loosening or a more stimulative approach by the Federal Reserve. And we look at two different major interest rates. We look at the federal funds rate, which as you know now is at 0 or 0 to 0.25% and has been there for over a year and a half. And the second thing we look at is the 10-year U.S. Treasury note. And it is just a shade below 2 3/4 at last look. Very low historically, but you compare it to the prior year, we're really in roughly the same spot. The federal funds rate has not changed at all for more than a year, and the Treasury note is roughly in the same spot, 10-year Treasury, where it was a year ago. So that would be a neutral score. So what does all this tell us when you add it all up? We have three measures that are positive for stock market growth, stock market price growth. We have one that is neutral. Therefore, the overall result, we would say, is positive. So the Barnyard forecast is that for the next 12 to 18 months, we believe that prices in the stock market will directionally head higher from where they are today. And certainly that fits with our overall view of the economy and of businesses and of the stock market. We think that we're probably in a pretty good place for continued price growth over the next 12 months. I hope this has been helpful and a little bit informative of how we do our own little bit of economic forecasting. And as I said on my September 2nd blog, we rely on far more than just one tool, but this is one more way that we try to estimate where the stock market will be going. Thank you and take care.